It's worth about 18 million quid.
Yeah, big numbers there, Jack.
I can remember every single thing that I've ever sold and what I've sold it for and what margin I made.
Oh, I can't do that.
and whilst I was studying, and in the summer before coming back for third year of uni, I earned more than 24 grand.
Jack Jiggens, property developer extraordinaire, serial entrepreneur. Welcome today. Thank you for coming down to our HQ in Swansea.
Thanks for having me.
Absolute pleasure seeing you again, mate. I always get golden nuggets and a surge of inspiration when I'm with you. Jack is one of the only people that I know, or I feel, is always doing more than me. And that's actually saying something, but you're so busy all the time and you've done some amazing things. But before we get into that, Jack, just give us a bit of a brief introduction about yourself for the audience so we can add some flavour to this meeting.
Yeah, cool. So thanks for having me. So as you mentioned, I'm heavily invested and integrated into property. I run a property development company with Ben Richards, which is called XPProperty. We're actually delivering about £35 million worth of stock this year on site. We also set up a measured surveying business, which is called XPSurveys, which we're trying to take to a national. When I say trying, we're in the growth period of taking it to a national measured surveying company. I also run an investment company with my brother, which is individual units, so houses, HMOs. We've built up a portfolio of over 100 beds to private rentals in that space. And we've got a slice of a pie of a social portfolio as well.
When you say beds here, if you've got a 3-bedroom house, you class as 3 beds?
Well,
single-let house?
The reason that we classify in beds is because that's our revenue marker.
Yeah,
right?
Yeah.
So if you own 100 KFCs,
you rent per bed.
If you own 100 KFCs, you rate on where you're getting revenue, and so you might rate on tills or whatever it may be. We're over 100 beds. I like to keep it as that phrase because we're forever growing. And but then we've also got, so that's private residential stock that we own. Yeah. And then we've also got co-own a social portfolio as well in South London.
Yeah. Okay. And that's quite a sizable portfolio, isn't it? That social business.
Yeah, it's worth about 18 million quid.
Yeah. So big numbers there, Jack. I've known you for years on the property scene, and I remember when I first started networking, young boy from Wales into the Lion's Den in London, and I remember seeing, you with your blonde quiff back walking through the crowd, because you're like, what, 7 foot, are you, Jack? Yeah. But I remember saying back then that, quite inspirational, somebody that I'm, looking up to, and, really what I was really saying in my head is I've got to do more than him. Because I'm a big fan of friendly competition. Yeah, I like being around people who are doing more, thinking bigger, and would you say, has there been anybody for you, because from what you've done, how do you grow a business, multiple businesses that big? And you mentioned there already, national surveying. How do you just get that level of, inspiration, aspiration, ambition, really? How do you do that?
Yeah, I'm a massive believer that, we mentor people. And I think one of the most...
Do you have a mentoring business as well?
Well, it is ad hoc. I'm a massive believer that we'll never do more training than we will developments. That's our business.
You'll be quite rare in the industry.
And we've got to make a few quid to catch up with the development company. But and one of the mindset things I always say to my mentees is, to some degree, whatever you want to do is possible, but you've got to figure out what you want to do. Yeah. Because if you want to do it, you'll do it. Yeah. So for me, the development company, we kind of know our capacity. Yeah. We're kind of getting to, Ben and I, when we both sat down and set goals, he had shifted from working at the Berkeley Group on a 960 flat development. Yeah. Met Tony Pidgley frequently and saw the ins and outs of that business. When we first met, he wanted to build 75-story skyscrapers right next to the Thames in central London. Nice. And I was probably a little bit more, I don't want to say grounded, because Ben's extremely grounded, but probably a little bit more close to home. Like I could see my parents were entrepreneurs, and I can see how their business, put them in a fortunate position for their legacy, for their pension, and for their life. Yeah. So I wanted to create that for my life and, my immediate family that I'm, soon to be creating and creating with animals at the moment. But
that sounds exciting.
Got 2 dogs is where I'm getting at, Dorian, before you get the wrong end of the stick.
I was getting the wrong end of the stick.
So for me, it was all, Ben was Mr. Berkeley Group, and I was probably a little bit more like, flipping houses and on the tools. That was how I started. So, but then once you realise what critical mass, in my opinion, you need to get to be a successful business as a development company, it is easier to go a bit bigger.
I would agree.
And we want to always be, and I know you're slightly different in your aspirations and goals, and your risk is different, very different to our business model. But we always want to be below Berkeley Group and above someone that's chancing it, and in that professional space where we're like a well-oiled SME company. We're very nimble.
Real business.
Yeah.
Not just a wheeler dealer developer type.
Exactly.
A real business. Yeah. That can run without you effectively.
Exactly.
Well, the traction's there without you anyway. It doesn't need you there. But you mentioned that. So you said when you started, if you bring it all back down to humble beginnings, then from that, amazing the businesses that you're growing on all different facets. Bring it back down to humble beginnings. And how did it all start for young Jack?
For little Jack. So dad was basically a builder to start off.
Okay.
So he obviously married my mum, and my mum's dad, so my grandfather, ran a construction company. They're like a D&B type construction company. So
mainly residential?
Pretty much all residential.
Okay.
And they did around Henley. It's quite a lot of exec homes, very little affordable stuff. So it's quite big, construction gigs to be getting onto. They delivered quite a lot of stuff. I believe they were turning over 10 million a year at one point. We're talking
years ago as well. Yeah, that'd be a big number today.
Yeah,
especially with inflation the past few years.
Yeah, still running today. Unfortunately, my grandfather's not in a position to still run it, but
it's quite rare as well for a construction company to be running it for that long.
Yeah,
so science.
It is. But so that was my upbringing and my growth. So when I was actually born, I was born and we moved to a bungalow. And when we moved to this bungalow, my dad decided to knock it down, live in a static caravan with me, my brother, my sister, my mum.
Wow.
For 2 years while he built our house.
Wow.
And during that, well, I mean, 3 kids, both snowy winters.
I've got 2, and that's crazy.
Yeah, I think my mum deserves more of a medal than my dad.
Yeah, that's nice of you to say that. Yeah,
but anyway, so that's grew up on site. My mum always reminds me of a story when she found me when I was 4 years old up on the roof, passing the roof of tiles with a cigarette butt in my mouth, and I was 4 years old without any PPE on, and that's just how I grew up.
HSC is not watching this video.
Yeah, well, I mean, that have to have a lot of information to go back to that day, and that back in those days it was.
Yeah, no, I agree. Yeah, it's slightly similar to myself, but yeah.
So grew up on building sites all the way through. Growing up, did a lot of like handyman work and helping people out, and I could naturally do quite a lot of building work myself. Then finished school. I really struggle to focus on things that I'm not interested in. If someone else is making me trying to get interested in it, you have to do a pretty good job for me to focus on it. But as soon as I'm interested in something, you can't get me away from it.
So I am literally the same.
Yeah.
That's exactly how I am. School for me, I was memorizing because I had to, because there is a system out there.
Yeah.
There's a benchmark. But I hate listening or being involved in things that I have no interest in. I really struggle with that. I don't remember things very well.
Yeah.
To really force myself to remember. Anything I'm interested in, it's like I've got a photographic memory.
Yeah.
I just hear things once, I'm a sponge, absorb it, and I just can't get enough of it. But yeah.
Completely agree.
Yeah, similar.
But going through school, I set up an eBay account, early teens, lied about my age on the eBay account. That's another one that eBay can look back at this and investigate me as well as HSC.
Daily Mail.
And just started trading items. So I'd buy and sell things. Yeah. And, when you say you're interested in, I can remember every single thing that I've ever sold and what I've sold it for and what margin I made.
I can't do that.
and it's just I remember it. And I've sold, over 500 commodity items on my eBay account, so that, I got a bit of a passion for trading, and I think I got that from my dad. He loves a deal. And he taught me a lot. I've got a fond memory. We were in Timberland shoe shop, and he started negotiating, and I'm quite young.
That's really rare.
And I thought to myself, we're in a retail shop. He's never going to get a discount. He used the lady's staff discount. He got 40% off. He got a free pair of socks, free set of wax, and walked away with something that. And I thought to myself, you can negotiate anywhere.
That's eye-opening, that is. So the treats you bought me today from Asda, did you negotiate?
I paid full price.
Oh, Jack.
Yeah. I don't want to get into a legal war with Asda.
Smart, yeah.
So anyway, trading was like one of my natural traits, but I was always immersed on sites. Went to university, studied business and marketing. I probably learned more about growing up and self-independence, and I did work permanently while I was at university.
Would you say that business and marketing course was valuable?
Not marketing. I actually chose as many modules as I could away from marketing once I joined. So
was it more business? You wanted it more for business, did you?
I did more business management. I love finance.
Yeah,
that's something I naturally can take on quite easily.
Yeah.
But the issue with the marketing nowadays is you've got someone stood in front of you that hasn't fucking run their own company.
Yeah.
They've worked for Coca-Cola for 10 years and now they're teaching you how Coca-Cola ran their marketing campaigns.
Yeah.
None of that's even relevant to me.
Yeah.
And I'm running a business now.
Yeah.
So for me, it was I just couldn't see the value in it. And actually the reason I didn't go into business and marketing is because I was looking at grad schemes that were 24 grand a year in central London.
Yeah.
And I was working as a labourer. I was basically management in a groundswork company, but this time at university.
Right. Okay.
And I was
whilst you were studying.
Whilst I was studying, and in the summer before coming back for third year of uni, I earned more than 24 grand.
Okay.
And that's just sheer hard work.
Yeah, yeah.
Like sheer hard work and hours. Yeah. I hold the record for the most hours worked in a two week time frame, which was.
Do you have it tracked here?
Yeah, 222 hours
in 2 weeks. 220.
2 hours in 2 weeks.
111 hours a week.
Yeah.
Wow, that's.
Yeah. It was setting up an event, so it was very intense.
Wow, that is up there.
And I could sleep on
See,
site.
and I think I work as I'm already. Yeah, see, like I need to.
I can't do that anymore.
End this. Go straight back to the office. Shut the door.
I can't do that anymore. But and labour works differently. You don't need as much brain power.
Yeah. Whereas
I feel when you get tired, your cognitive function does go quicker than your mobile function.
Yeah.
But anyway, so I was earning more. And I was like, I'm not going into that. And I actually went into a sales role because if I can do that many hours.
Yeah.
And close that many deals, I'll be the highest paid in the office. That was my naive thought process.
Okay. Yeah.
Learned a lot, did all right.
Right in that exchanging time for money mentality.
Yeah, exactly that. Went into it, did all right, did pretty good. Learned a lot about sales.
Did you like sales?
I love negotiating, and in the role I was in, there's very little negotiation. It was more being a pest and basically ramming it down people's throats, which I'm not a massive fan of. And why I didn't like the environment. Yeah. So I quit my job after a couple of years. So
you stuck it out for a couple of years, though?
2 years.
2 years.
Yeah. Ego was keeping me there because I knew that anyone that doesn't last that long in it gets a tag put to their name. Oh, right. You know, you broke within in a sales office with like 100 like testosterone-driven men.
So that
if you leave. It's you can't handle it. You broke.
Yeah. So that fear of giving you notice and walking out, and it was like you broke. Yeah.
But coincidentally, when I handed in my notice, the director that was there for my exit interview, you could call it, was like, "So what do you want to do?" And my first response was, "I want to grow a company that's turning over more than yours." And it wasn't to be rude. It was because I couldn't see me doing that in that role.
Okay.
And coincidentally, when I left, they were turning over 30 million, and I've just already talked about what we're turning over in one of our businesses. So that was my ambition, and that's where I wanted to be. It wasn't anything to do with that business, the role, or other people that are successful in that capacity.
Well, it's interesting because there's a common occurrence, they say, with entrepreneurs or business people. There's always this underlying drive, making them push for more and more and more. And most of the time, that drive is not actually personal money for themselves.
Yeah.
Like, I know it's not for me.
Yeah.
Would you say, what you anchored something there that, that spurred you on? Would you say that was ever a subconscious driver for you, or is it something else that's made you push for, relatively really big heights in business?
So coincidentally, when I said that, I don't know why I said it, but I knew it was true.
Okay.
But I don't know what, brought me around to saying that. I actually looked at that business. And when I left, there was about 130 employees, and when I joined, there was about 60.
Yeah.
And I know someone that joined when there was 6.
Okay.
Right. So I've watched it go.
Oh.
So
pretty sure that's illegal.
No. There were 6 people.
Oh, sorry. I thought you said. Okay.
No. So when I joined, there was 80, say, 60 to 80. And when I left, there was 130. And when a friend of mine joined, there was 6.
Yeah.
And I watched the people that joined in the first 10 all get to directorship level.
Okay.
All do really well out of it. And the 2 directors that set up the business do extremely well.
Yeah.
And I just joined a moving train as a part
Yeah.
And that part wasn't me. I wanted to build the train.
You wasn't in the first carriage.
Exactly.
Yeah.
So I think that's where I was getting at with that. And I didn't know if I believed I could do it. I just wanted to give it a go and see where I got to. So handed in my notice. Obviously, I'm from a family of builders, and I literally decided that morning I was going to hand in my notice. No prehistoric thought.
Right, okay.
It was 5th of January. I can remember it clearly.
Must have been a cold morning.
I think I was 22 and a half or 23. Went in, handed my notice, and then I was like, right, well, what do I do now? And a family friend of ours was delivering a house development.
Yeah.
Knocked down a bungalow, we were building a new one. I thought, I know how to work the tools, so I went and worked with him. And we were chatting away, and he was like, so what do you want to do? And I was like, I don't know, I've got some money saved. I'd sort of quite a significant amount of money saved for a young 20-year-old person. I was like, I want to give him some sort of business go. I was quite into my fitness then.
Yeah.
And I was like, something along those lines of business. And he was like, well, you've got a load of money. Why don't you put it into this house? And that's what I did. And then
bought a house off that?
No, I funded the work.
Oh, you funded
the purchase.
Okay, interesting.
But then we did.
Did you get security?
No, cash.
Wow.
And then we delivered it together. Did an equity JV on that essentially, which I didn't know what it was. Everything was cash.
Wow.
We did sweat equity, so we worked out what we spent time on it, but it was both of us working for 12 months to deliver. It was quite a big house.
Right, yeah.
And we ended up selling that for just shy of 900k.
900?
900.
Wow.
Bought for 4, spent 2.
Okay.
So good turn.
That's good catapult, that is, yeah.
And I just thought to myself, we actually finished that house, and while it was being sold, the neighbour asked us to do their roof. So we went, we're not really, client work roofers, because we'd done such a good job with our roof. It was a nice brand new slate roof. So we put forward a price with like 50% markup on it, because we were like, we don't really want it. We want to do another project, and they accepted it. Then another house, the other side, did the same thing. So we put another 50% markup on it. But anyway, we did a lot of client work in between jobs selling. So we were cash buy, put it on the market, do client work.
Sounds like making good money too.
Try and find another gig. And then when the house sold, we're technically part of the chain.
Right.
And then it got to a point, I've given you the full-blown story now, but it then got to a point where I looked at, so Matt was the JV partner, and I was like, I want to do 5 of these a year. I'm young, I'm hungry, I've got the risk appetite to, cock up and go broke and try it again and try it again and try it again. He was 58 and he didn't have the same tenacity and nature, and he was like, I'm slowing down, you're speeding up.
I want to do one of you.
So we parted ways, and he now actually does some of our work for us.
Really? Look at that.
But
full circle.
Yeah.
You put a 50% markup on his work? Well, you're looking
he's just on straight day rate.
Oh, he's on day rate.
Yeah, he does our. He did a 6-bed, 5-bath HMO for us on a day rate, managed trades, and then I managed him. But yeah, he still does bits for us.
So then you sold that house, great catapult for such a young age as well. Then in terms of money, and was doing those projects on the side. Obviously, from there to where you are now, you must have gone through and experienced a lot of challenges and obstacles along the way. Seems like you've got a very strong memory here. So what have been the key challenges that stand out for you getting from, like I said, humble beginnings there? People watching this are going to be either in a similar position. They may have been working for several years, saved up some money. They may have even done a first project or very interested in doing a first project. How'd you go from that to multiple businesses, all doing multi-million-pound turnovers, deck £1 million worth of projects live, tens and tens of millions of pounds raised and probably sold. Along that journey, what's been the biggest challenges?
Yeah, I mean, it's the golden question, really. I think the biggest challenge to start is you underestimate what you can achieve in 5 years, and you overestimate what you can achieve in 1 year. I think that weans out a lot of people that think
everyone's got big yearly goals. I can do this in a year.
Exactly, because there was a couple of years, but so me and Matt did, let's say, 5 client projects and 4 personal projects between us within the space of basically 2 years. After that, I had a bit of a dry spell where I was struggling to get deals closed. I was going into more complicated deals of like HMO or splitting to flats, and we'd never done that before. So the learning part for me over those couple of years and keeping faith was really key. And the way that I sort of bettered that process is I took a project management contract for a year. We were talking about it earlier.
And like freelance, was it, or was it a job?
I was a self-employed,
So yeah.
but it was a fixed contract for the whole duration of the project.
Yeah.
Because I knew that if I did my own projects, I wouldn't be studying before or after work in lunchtime because it's my project.
Yeah.
So I specifically took that so that I could listen to podcasts, learn, go to events,
Yeah. Okay.
invest in my learning. So the first key, tip is just invest in yourself and learning, because I feel that you'll be sure to make a mistake before you learn something new, and making a mistake is part of learning.
Yeah.
And I don't massively believe in a mistake unless it's made twice.
Yeah.
You should have learned from it.
100%. Is that Stephen Ballard's book, that Diary of a CEO? It's one of the lessons, principles in there is these pots, and what is to build that pot of knowledge up. Because if you, for example, now, touch wood, and obviously it won't happen, but if you had to start again now, but you had all your previous experience and knowledge, you'd get
way quicker.
You'd get off the fly and start. Know exactly what 100%. To do.
So I think the first challenge was naivety and struggling to really have clarity on what I was good at, what I could do, what that looked like, how to foster that vision, and the vision was blurry and I didn't even know how to implement it. So I suppose naivety first off was a bit of a challenge. I'd not borrowed £1 from a bank to do 8 projects, and now we're going in to try and scale a business where you've got to learn about all of that. I would have said the next biggest challenge is actually implementation and getting going on a strategy, because it's difficult.
Analysis paralysis type thing, is it?
You kind of, so the first HMO we ever did, it was a 3-story townhouse. We bought it for 270. The way I justified buying that was that if we didn't fill the rooms, I would be able to sell it and not lose money. That was it. And that was good enough for me. And that gave me the confidence to do it. And it works. We filled the rooms in a day, and now we've got a portfolio of over 100 beds within a mile of that house. But you do, when you don't know what you should be doing or how you should be doing it, you do struggle to commit and make that decision and think it's right.
And when you're building that knowledge up, you said from your first key challenge in terms of learning all the time, you get exposed to so many different strategies, business models out there.
Distractions, I call them.
Distractions, But when you're first learning, it doesn't seem like a distraction, because it just seems like
it's new.
It's new. I want to learn about that, and there's opportunities in that. And you'll see this. So because you were a prolific networker like I was, and I know you still go to lots of events now, whether it be speaking or just attending. And there's always people in the room, even now from when I last went, is, what do you do? I'm a developer. Or where do you develop? Everywhere. Right. What do you develop? Everything. Remember those?
Yeah. I mean, that's one part of the learning and meeting people, is there's a lot of people out there that don't say actually what they do. They exaggerate, and social media one thing and actual reality is another. The classic revenue is vanity and profit is sanity.
And cash is king.
Yeah, it is. So there's a lot of, I believe, people talking in our small networky property world. There's a lot of people that over talk what they actually do. I think that shit does go wrong
all the time,
and in reality it happens. It goes wrong more than it goes right, but it's all about managing that in that process. So we try and give a real view across whatever we communicate. But I think that one challenge is taking the first step, and we found that difficult because I was running an investment company, running a development company. The development company started out with Ben and I. A lot of our team forget that it was just Ben and I, because they say, well, if I go away for 2 weeks, how are you going to run the business? So like, don't you worry, you got it covered. And I think one of the challenges we've predominantly faced in the development company was the first deal is always the most difficult, in my opinion. The first investment relationship is always the most difficult, because the first deal we ever did, we probably had 15 potential investors, and we didn't really have the confidence ourselves to be like, why aren't they doing this? We thought there was something wrong with the scheme or us.
So when that first deal, you said 15%, was that the pipeline of investors you built? It was about 15, was it, to try to get money for the deal?
For that deal,
Okay.
Yeah, and we closed the deal with an investor that we've got a really good working relationship with now. They'll 100% do stuff with us again. And actually, the if they would have turned around and said 75-25 split in our favour, we would have bowed. Fortunately, we didn't, or they didn't. I can't remember the conversations because we're going years back now. But now, if someone pushes that, we shut the door and go, see you later. It's that confidence of knowing our worth and our value. And that doesn't come from nothing. You know, we've got good technical experience from construction background, and Ben's got good technical experience from architectural practices, structural engineering business, and working for the Berkeley Group.
Definitely.
So I think we're one of the better of the bunch. So we weren't that confident. So that's another one.
Yeah.
Self-confidence as well as the confidence in the project. And I think one of our biggest challenges, which I know you're going to agree with, is cash flow, because all of our businesses are growing of the opinion unsustainably by an account of a lot of other businesses saying that's unsustainable growth. You know,
doubling high growth, technically over trading.
Exactly. Yeah. But in my opinion, it's easy to do that in development companies for the first few years, because if you buy one site or you buy two, it's not that much different, but you're doubling, right? Yeah. If you then buy 4, that's still manageable. But then when you buy 8, we bought in our third year of trading, we bought like 11 sites.
Well, you have a stat for this, don't you? Do you, on average, I don't know what it is now, but how many weeks is it per? How many weeks per development do you buy?
So houses and development across the group. Yeah. So Central Street and XPProperty.
Yeah.
And the social business. So tracking back 6 years, on average over those 6 years, we've bought an asset every 4 weeks. So, just inside 4 weeks.
So that's just purchasing an asset every 4 weeks.
Yeah,
that is phenomenal. You know, that really is phenomenal. Yeah. It's such a, like I said, go from, you know, we call it young Jack there. Yeah. You know, never worked with an investor before. You know, would bow down to 75% profit split in their favour. To fast forward 4 weeks on average.
Yeah, it's almost 80 things that we've bought, houses and developments, since we set up the business 6 years ago.
And nowadays, you're also, you know, you've built such a reputation and a name, and work with so many investors. Have you calculated, in terms of, from an investor point of view, how many investors you've worked with, or the amount of money you've raised? It's over 10 million, surely, isn't it?
Yeah, so some stats. We've got 165 people that have been pre-qualified, and we would work with them on our investor database.
Yeah.
Obviously, some of those have routinely worked with us, and some of them are new. And you know, we're trying to foster relationships now with bigger investors because they could do more.
Yeah.
We've outgrown a lot of our investors, but we're very appreciative that they were fundamental parts to get us where we are. But they're more retail investors.
Okay.
And out of those 165, we've closed probably in excess of 100 investment deals with investors.
Yeah.
And I believe we've raised about 15 to 16 million in private finance that we've executed sites, and at the moment is sat at just below 11 million in investment.
Amazing stats, but also for those listening, you know, it is possible. There is money out there, lots of money out there. But always one of the biggest questions for those looking to get into property investment or development is, you know, we do it. So we see it on the marketing for our videos as well. Is all well and good if you have 500,000.
Yeah.
But obviously the key thing is you have to work and collaborate with other investors to do that. And the key question all the time is, you know, how can I work with investors? Where do you find them, and how do you work with them? So any advice for people listening on that?
Yeah, so I mean, my advice, if you're going into some form of property is start small and grow, because you need to build that experience.
That's interesting. Record. How would you define small? Only because I've seen some was like, you start big.
Okay, yeah, actually, let's phrase that. Start with what you're capable with, and grow with your capabilities.
Yeah.
Because you're investable at that capable value, in my opinion. So therefore, if it's we know a mutual friend of ours. He was a project manager for some sort of absolutely outrageous infrastructure leisure project.
Yeah.
He's very investable to do a 300 house development on his own. And he's starting out in his own company. He's investable at that level. When I started my own company, I wouldn't be investable at that level. I would be very investable for a detached new build house. I've been there, done that, worn the t-shirt. So rephrase that to your capabilities and grow with them. But then you can assess what type of investor you need. If you're starting a 10 house development, it's not going to be your auntie that's going to be investing the money. But if you're starting a house,
unless she's very rich.
Yeah, I mean, even still, you might want to approach her slightly further down the line.
Yeah, I understand.
But analysing what sort of value you need. So we did start working with retail investors, people that had, you know, small cash pots. We did, you know, loans as low as 50k for some projects. And we made up the difference, delivered the scheme, did a payout and moved on. We've now grown, and we're now actually, in my opinion, moving to more commercially minded high net worths.
Yeah, yeah.
And that's what we've been closing a lot of investment recently. So people that have probably got 2 to 10 mil liquid that they can invest in property development specifically, and they've made that decision to do that. And all they need to do is like us, trust us, and like the scheme. Yeah. And as soon as that's, those 3 things are there, we can normally do the deal with them. We're now out in the market trying to find one facility to not fund all of our deals. We'll always work with a few of the high net worths we've been working with lately because they can keep up with our growth. But we want to build a facility with a partner, a growth partner, that we can sort of whip out the responsibility and the time, because 45% of my time is capital raising for deals.
Okay.
I'm a developer.
5% of your time.
Yeah.
Wow.
I'm a developer.
What would you do if you managed to get that line and your percentage of time now drops to 5%? Because it's really more relationship management.
Yeah, I'd work on scaling central suites more. I'd work on scaling XPSurveys more. And
more scale, more growth.
And I believe that the XP's growth is really not nicely at critical mass, and it's now when we start to see the benefit of that. And that's taken a lot of work, and cash flow's been the issue of that growth. If we didn't grow, Ben and I could have easily retired early and kept consistent.
It's like that here. If we don't grow, cash flow is okay. But if you grow, especially because the nature of the beast, we're investing now we talked about it. We're investing now for sites we're going to be on in 2 years. It's really difficult. If you say that out loud, people, it's quite a difficult thing to comprehend. You've got to put away tens and tens of thousands a month.
Completely agree.
And it'll come back in years.
Yeah.
So, from everything you said there, you just touch on it. And I know you're very systematic and strategic thinking. Where are you heading? What is the plan? What is the goal? Where do you want to take XP and your suite of businesses?
Good question. I don't believe XP Property is a very saleable business.
Okay.
I believe that there's a likelihood that Ben and I will both have quite an immediate handle on some of the business, and we do enjoy it. We do enjoy what we do. I enjoy specifically bringing the team up, getting the best out of them, and being that, I suppose, sort of colleague friend role. And we do challenge, in our opinion, we punch way above our weight for our size and age. We challenge the people that have been around forever, and we pinch sites from them and do this, and they didn't see that angle, and we do that. So we love that satisfaction. Is XP ever point saleable? I'm not of the opinion of that, and I think that Ben and I will be growing that, and our value is in each scheme. Okay. So we've got to keep the trading co going to keep the schemes going. Obviously, we'll have probably less debt across the portfolio. We'll probably do things in a slightly different way. We could be more selective on what we deliver. We could even partner with other businesses to do more JV collaborations on, we've got this site, we don't want to deliver, you do that, or whatever. A lot more strategic, and also sort of top-down investing in ourselves, so that we're the investor. And having built that well-oiled machine is requiring less of our time, but we're getting double the bite of the cherry. We're getting the investor pot and our pot. And then also investing in other developers, I think, is a part of what I want a part of XP's future.
Okay. You see yourself going down that route, do you?
Yeah, so that's XP.
Don't forget me when you do.
I won't. Well, we'll race to see you can be the first to lend each other some real money.
Yeah, that'd be good.
Not a 20.
Well, I've always said that if I had a line of credit, if I had money there was serious money, I would lend to you 100%.
I'd say the same back.
Yeah, I would. And that's the thing is that you see what the biggest obstacle I see in my business, and the same for yours really, is just that available amount of money. Really. I know there's lots of lessons and everything along the way, and the team is really important, but you said cash flow is so critical, and it does impact how you make decisions, how fast you can jump on opportunities if you're choosing to dial up or dial down the business, which is the thing. So, but that was XP Property. What about the other businesses? Yeah,
so Central Suites, we want to, what me and my brother want are two different things. We're two different profiles.
So, you're in business with your brother.
Yeah, and I want to scale it to realistically thousands of houses.
Do you? Thousands of houses, do you?
Thousands. I won't be specific on the exact target just yet, because we're actually modelling it at the moment. I want to grow to 1,000 houses. We're using the HMO model because it's really strong cash flow to reinvest the capital to grow and scale quicker.
Okay.
And then I want to get to a point where we have a big cull of the portfolio of underperforming assets that we don't want to keep or hold in certain areas. Problem with we've got quite a lot of grade 2 listed buildings and bits and bobs like that. And then revert all of the HMO products back to single lets.
Wow.
And have a significant portfolio bringing in cash that's, in my opinion, like a family-led legacy portfolio.
And you see that being a single-let portfolio?
Single-let portfolio.
Interesting.
The cull will mean we can de-lever, maybe even completely unencumbered.
So the HMOs you're doing now then, is for that ready in mind then. Are you going the full out, en suites or rooms and,
we're not.
Design being like...
Yeah, we only own, we've actually just bought it last week. We only own one HMO that's over 6 bedrooms.
Okay, so
most of them are very
beds,
housey. Yeah, 4, 5 and 6 beds.
4, 5 and 6 beds, okay.
Yeah, all of them. And we like it that way. Yeah. So we can easily, most of the 4 beds is just the sort of snug room, or the room on the right is a bedroom. The 5 beds, granted, there's more en suites in there than you would need, but that's easily redacted. $6,000 repaired, get family in there. And then the 6 beds, they might be the ones we cull. And in a lot of the areas that we operate in, there's no Article 4. So if we do get an Article 4 direction in, their value's gone to where it needs to be. Yeah. I don't want the management of that forever. Yeah. Let some other young, enthusiastic individual get really excited about their new portfolio. Yeah. And I'm just sat there quietly with a single let portfolio where we can manage probably 1,000 doors with a few people, whereas we're currently managing about 100 beds per person.
Okay. And then obviously that model with those single let family homes, very good for appreciation.
We're in Oxfordshire, so we've just had a 6-bed valued up at 800k, bricks and mortar. Wow. Bricks and mortar valuation.
We do a lot in Wales with that. I don't think our appreciation is going to catch up to Oxford, to be honest.
Henley won't allow a Greggs in Henley. So.
I actually was in London yesterday. I had a Pret a Manger.
Oh, very cute.
I felt like a Jack Jiggins. When they asked me for my name,
did you feel 7 foot tall?
I did. Yeah. But no, I mean, that in itself is is a good, clear plan. It'd be interesting what happened between you and your brother there on that. But I'm guessing realistically, his family as well. If it's a family exit thing, it's just whichever way a number you settle on it. Either way, that's probably the route it's going to go to. Yeah. And then where do you see XPSurveys?
So XPSurveys, I think, is the most exitable or saleable business. Okay. The reason we set up XPSurveys is because we thought that the industry was just so archaic, slow, corporate, very clunky. If you wanted a measured topographical survey on a site that you're buying, you'd have to call up your surveying company. Yeah. You would then get a quote back from someone in the office that might need to cross-reference that with a surveyor to get an exact value and time that would be spent on it. Yeah. That can take anywhere between, realistically, 1 day, and we've seen some come back in like 14 days.
Yeah, that's what happens with us, because you don't venture into Wales, do you?
We will. We'll come back within you can get an immediate quote.
Well, after this, we'll have a look. We'll compare it after this. We'll have a look. Because that's what happens with us when we get topographical. Yeah. It's going out to the list that we know that do it. Yeah. Saying here's the site, sending the details. They come back with a quote. Sometimes it's within a day. Most times it's within a couple of days. Yeah. Sometimes it's a week later.
Yeah. So we acknowledge that. It's actually, so we launched and put a lot of money and time into our online quotation tool. Okay. It's really good for getting quotes immediately for measured building surveys and houses because it pulls information on the property. Topos are a little bit more difficult because it's got to work out ordnance survey data, title data, which can be wrong. So we'd actually rather do that manually. But what we're doing is 95% of the quotes that we don't have to do gives us the time to be quicker on the quotes that we do have to do. So we've got an online that could go national. Well, it is national quotation process that sort of whips that labour at the front end, so we're quicker to get to quote. People can actually book the survey, book the day, pay for it. They're all online from just that actual automated process. Yeah, a bit like We Buy Any Car, but for surveys. Yeah. The way I actually angle this to a fund the other day is, imagine if We Buy Any Car had to get someone in the office to review your car and come back to you with a quote. How many leads they would lose? Yeah, it's just that convenience and speed. And when you're a developer like us and you're carrying a site that's costing, we've got a site that's costing 10 grand a week. 10 grand. If someone gets there to site quicker. That's in debt costs.
Yeah, well.
So if someone gets there a week quicker, we save 10 grand. So I don't care if the survey's 4 or 3 grand. So anyway, so we've got the technology that's backing it. Whether you do a survey in Wales, Scotland, Plymouth, Newcastle,
and then you want
London.
to scale that then with what, subcontractors to doing the service?
Yeah, so we're looking at franchise models, one-man bands that don't want to do sales funnels, marketing, converting leads, driving business, SEO, PPC, using our automated quotation tool. They can sort of tap into just subscribing with us, and we throw them work, and then we obviously make a markup feeding that end, so we can get a quite good handle for the one-man bandy type surveyor. The market is like market leaders turning over 20 plus million and one-man bands.
Wow.
So we're currently in between, and that's not a great space to be in because it's not that profitable.
Called Death Valley.
It is. It's
you see that in businesses. There's like these businesses at certain levels, and then in between is like called Death Valley. So because you're in that middle, you've either got too much overhead and not enough revenue.
Correct.
So you can't make money. It's one of those.
So we're in Death Valley and growing, which is fine. You know, you can't be in Death Valley and stationary. But if we did an exercise, if we 6x'd our revenue, our overheads wouldn't double.
Yeah, it's like that with this business too. That's why we have an overhead to revenue ratio, and that's where a big part of that Death Valley comes from. It's like you gear up to this point, and you're going to get to that point. Your overheads aren't going to quadruple either. But to get there, your overheads, you have to bring in the overhead first. Try and get there. And if you don't,
which is a better problem because it's good to get the revenue in.
But it comes back to cash flow.
Yeah, exactly. So you grow quickly or die slowly. So we have a good handle and a good map of how we can take it national. So it will be subcontractors, independent surveyors that have their own kit, their own PI cover, their own ability to deliver A to B, and we can give them the work and then make a markup for basically being a hub for porting out leads. Or we can actually not relocate, but open up a new branch and replicate what we've done. And all the foundations that we're building now is to build, 20 million plus business.
Okay, that's
but
what you want to get.
We're trying to implement that today. Doesn't make a huge profit margin, but we're not thinking about today because we've got other endeavours, and that's where we focus our
makes sense
opportunity side of things.
Okay, cool. So we know a lot more now about where you are, and we know a lot more about where you're going. So getting there then for the next period of time, for your focus on all of those businesses of that scale and growth. What do you foresee to be the biggest challenges? What's on Jack's mind to get right?
So XPProperty, the two, we're good at construction, we're good at finding sites. So the design, delivery, planning, we're comfortable with. We can do that bit. Some of our niggling problems for growth has been the investment size pots.
You mentioned
2 years ago. Our average investment size across 60 deals was 450k. We've just raised 2 7-figure investments on one standalone ticket. So we're resolving that problem, getting out there and trying to find bigger institutions or even bigger, deeper pocket high net worths that can grow with us rather than we've been doing it to fund that deal. And that's a big common error I see in property development. They get that deal done, but they don't focus on the business. And then we're now focusing on funding the business and our growth rather than funding that one deal, because then we outgrow that investor and we're back in the same, recruiting for new investors.
Makes sense.
So funding, which we're tackling and getting in front of the people. I know that you do a lot of time. A lot of your time.
It is
capital raising.
It's about having those conversations and trying to get those those branches of the the high net worth, the family offices, the funds, the corporate finance brokers, the ex-bankers of the world. You want to get into those circles, and you just never know, when you're speaking to those types of people. Like I had one this morning before I met you, and straight away in their mind, they've got a list of family offices or ultra high net worths. And, when you're raising money for the business, you only need one yes, really. You only need really one rather than 160, which is a massive feat. And but I could see why it takes up 45% of your time. But when it takes up 5% of your time, like for me, I would say, it does take up a big portion of my time, but I would actually say it's about 10% of my time, to be honest. Once you get that down to 10%, you'll be just like those targets I told you about last month, Dorian, 10x. We're not going for 20 million turnover now, we're going for 200 million.
Yeah, when we get there. So XP funding, which we're tackling and resolving, we've got a lot in delivery at the moment. So 35 million of development that we're on site, but essentially on 5 different sites. We de-risk our construction with fixed price contract with a different contractor on every site, so that one going wrong doesn't impact us hugely. That individual scheme might be further delayed, and we might have to shift a contractor over or equally get a new contractor in. So I don't see a huge risk in our construction. Obviously every site has problems, and we're there to deal with that, and that's why we actually fix a price contract with a contractor so that we can firefight, manage the contractor, bring in cheaper second fix items and FF&E and whatever it may be. And then exit is a big one that I'm going to be focusing quite a lot of my time on, because we're in a more cyclical market, in my opinion, than you are. We're in private residential sales. A lot of our stock is in a good space in the market. It's first time buyers upwards to downsizers, so we got a lot of market movement. We don't do much luxury stuff, but we have some luxury stuff at the moment. We're delivering 9 luxury flats in Muswell Hill, North London.
Right.
But that's 9 out of the 70 plus units that we're delivering.
So relatively low.
So our diversification across sites is pretty good. But if we have a market like we've had, like COVID, using as a more recent example, sales went through the roof, the market went crazy, and then I actually believe it came down equally as quickly, because activity was sort of nursed into a very short period of time.
Right.
Estate agents had a great year, and now they're struggling. And we don't want to be part of the struggling. We want to de-risk that, because that can come. It can come as quickly as it comes, it goes.
How are you going to de-risk that?
So we're speaking to. There's several different ways of exiting, but we're managing processes internally to make sure that we are the best product for that price on the market, regardless. So internally, we've got
not just through incentives now, but this is actually through like what, design, layout, or finishing. So finished products, sales incentives, making sure you got the best 2 agents on the site, making sure that the person that you're actually dealing with the agency cares about the sales, because quite frequently we find that falls by the wayside. You get someone coming to value the site, they tell the dream, and then you get given to someone that's 21, just starting, doesn't have a clue about someone. The people you speak to want to get the listing, get it on the portals, and then whoever's doing the viewings. I've seen this time and time again. Somebody inexperienced, there's no selling, they just open the keys and say, have a look around and let me know what you think. Which
the property should sell themselves, but it's essential for someone with sales attributes to be in that process and incentivised financially. So taking part in the sales process, but we're also looking at, we've had some good conversations with particular funds that want to back our business, but then also want to buy the product at the end into a REIT or into the fund. Which de-risks it for us, because then our exit is forward sold. That works well for our, I would call rentable stock, because the yield's there, it's rentable, and rents are pretty stable in the location we are. And even in a cyclical market, rents seem to perform differently to sales.
I can't remember the last time, and I've been doing this for 10 years, I can't remember the last time where the rental market was difficult. There's such an undersupply of rental. And that's getting worse and worse and worse, because even though the market is softening for sales, it's softening because nobody either wants to buy because of mortgage rates and stuff like that, but it's nothing really to do with the underlying fact. So many portion of the population can't afford to buy, they don't have a deposit, and there's just not enough homes. So rental is always going to be strong.
Completely agree. But one of our investors delivers prime stock in central London, talking £8 million per flat.
Wow.
And one of the reasons that he's invested...
It's more than an entire scheme we do.
I know. One of the main reasons he's invested with us is because when we're knocking out 20 flats, if we sell 2, we can refi, stress test on rental mortgage calculator.
Our low risk. Right.
He's then got 18 units generating rent with us. And he doesn't have to sell 1 unit. He can sell, part of it, 10%, 2%, 50%, all of it. So our model from a rental perspective is quite robust. The difficulty we then have with holding those as stock is you can't spend equity on staff salaries. So it does limit growth. So that's not our preferred model, but that is a backup. And our business model does suit that fairly.
Yeah.
I think we've gone through quite a rocky road for the last 2 years in mortgage, stress test calculations, interest rates going up, and our portfolio has been stable.
But I know you do stress, because it does make sense if you're focusing on developments. If you're going to do a development to sell for the open market, and you look to consider what the rental level is, how high can you stress that at the loan to value, the maximum to value? What does that sale price still, or close to it, still work if you had to refinance it at a stressed mortgage based on the rent for the area?
It does by most part.
Yeah.
I mean, at the end of the day, if you're doing low margin deals, you're going to be in trouble in sales or in rent. So making sure the deals,
unless you've got a strong equity partner and it's a good percentage there. But
even still, so we do a monthly investor report to all of our investors on each site that they're invested in, and our investor, that same investor, sort of pinged a message back about market sentiment.
Okay,
we're stripping out. Like, he's thinking way ahead of where we need to. But what I did was some analysis to work out at what gross development value do we have to reduce the whole scheme at to sell as a fire sale and break even, and it was 36%. So for me, if you got the headroom in the scheme, if we refinance and take a 10% hit on the GDV, we're still okay.
But that's important, because you're doing that at appraisal stage, and there's a lot of developers that don't do that. You've probably come across them as well, and they can get caught out if the market softens. Especially if they've only ever done developments in a rising market. I've seen it the past few years in the rising market, developers left, right and centre. I've said this time and time again, house building, traditional house building and private development is probably one of the best business models to be in a rising market. Because the amount of value, the leverage you can get, you can do a £10 million deal with very, very limited money yourself. In a rising market, it's the best model ever. We're really... in a stagnant or declining market, it's probably one of the worst business models to be in.
Completely agree. I mean, and you touched on it, leverage helps you in a rising market, but works against you.
Definitely.
I actually believe one of the main reasons that it's a low barrier of entry for people to go into housing refurbishment or development, because if I said to you, set up a limited company and set up a business, you would be working in that for 3 to 5 years, trying to get a product off the ground, and it would take a lot of time and energy, and it's not that transferable, and there's a high barrier for entry for that to be successful. But doing one project is essentially a whole new business in itself. And it's people don't see it that way. They see it as I fancy designing something. What does it cost? How do you gear it? What's your risks? So completely agree.
It makes sense. So then, again, in terms of you achieving your plan now, so one of your main, we're talking about how you were de-risking your venture, and you're doing that through a combination of tactics like sales incentives, and also getting the multiple agents on board and designing correctly, and really being thorough with your analysis and your appraisal, and you're looking at the research there. So anything else major you're doing from a de-risking point of view? So obviously forward selling, you mentioned.
Trying to secure something that can be forward sold. Always making sure there's multiple exits. So making sure that the scheme balances and cash flows strongly with a refinance model, and holding the site. We've got our own management and lettings business. So for us to
do that in-house too?
For us to bring that in-house, we're not giving that, for example, 12%. We're not giving that revenue to another business, and we've got a better handle on it.
It's more for HMOs, isn't it? 15% for HMOs?
We charge about 16% for a client HMO, but we don't do much of that. But essentially, it's also... I personally believe I'm from an area where it is quite affluent, and we want to stick to those affluent areas where there are people constantly relocating and moving because it's a desirable location, and that area of the market does, whether it's a 200 grand flat or it's a £1 million house, does move in more difficult times. And that's the main emphasis, as well as the product, the sales, the forward funded de-risking, and also equally location. I just don't think you can beat location.
Location. So okay, what's one question I did have for you was the emerging market trends. So we're seeing, especially at the moment, it's the market. There's been lots of developers, and they've all got different strategies or tactics they're trying to implement at the moment. But bit longer term, is there any kind of trend or technology you're seeing disrupting the sector a bit more? A couple of people I've been speaking to are still very much into crypto and blockchain, and see that that's going to be coming more and more. Is there any major trend that's exciting you at the moment?
I mean, at the end of the day, I'm the builder, right? I'm born on site.
Yeah.
Not necessarily, I like my numbers, I like my spreadsheets. I don't mind integrating a bit of tech, which is what we've done with XPSurveys. But I like to keep it simple. I think development is a really difficult space to grow an SME property development business well and stay alive.
Yeah.
And where we're at is, we are in the process of trying to make our companies from good to great. And I believe the harder it becomes, which it is, with planning delays, funding difficulties, leverage difficulties, refinance difficulties, I think the opportunity for us is to prove what we do and then expand out to those other developers that can't do it and take over their sites and take the sites because they've caught a cold on X, Y, and Z.
Yeah, so one of the big trends you're seeing is the fact that others around are either over leveraging / failing. There'd be opportunity whether in their pipeline or their part finished sites. Really,
I think we've been through an interesting few years, and I think that the luck and market and capital appreciation hasn't been on everyone's side.
Yeah.
So for me personally, sat here running a development company, which we're sharp, we're dynamic, we like de-risking things. We don't ego build. We don't build something so we can put our name on the front of it and get a photo in front of it. We care about the numbers.
Your block of apartments then, is it called Jiggins House?
No.
Oh, okay.
No, none of them. We haven't renamed anything. Original naming. And the main reason being because we focus on the numbers, and the numbers take care of everything else. Some of our sites might not be the prettiest, or the best thing that you see on LinkedIn and gets 1,000 likes because it looks really sexy and it's got loads of.
Well, our best post was our site next to a graveyard.
There you go.
The opposite of the definition of sexy.
It's people dying to get into there.
Well, that was actually a comment you've,
yeah. So for us, it's focusing on the numbers. But I suppose for anyone out there watching this and listening, I think the development space is great. I think it's quite a difficult space to get into and do really well out of. Just because I think that there's more and more red tape, high barrier for entry. I believe that you kind of got to get a bit bigger to see the real benefit rather than doing it slow time. Personally, we're trying to avoid cash flowing planning. So we're trying to get conditional contracts. We're trying to take sites on that have different planning plays like Class MA and permitted development. I'm not a massive advocate of the stock that you might end up having to deliver with an existing footprint with bad window lighting and an existing horrible, ugly office building. But at the end of the day, if that turns the screw on the margin, we'll do that scheme.
Okay.
So
very numbers driven, yeah.
Very, very we're always numbers first. Yeah. Everything. So we're focusing on. I'll give you our metrics that we actually focus on. So we basically have like 3 or 4 that we don't ever remove from. We won't do a scheme that doesn't return 200k net into our business. Okay. The reason we get to that is we're talking about critical mass and being in that Death Valley that you're on about. We know our critical mass size of what we can deliver, and that is our mandate for our business internally. We aim that all of our sites return a 20% IRR for all of our investors on 50% of the profit. Okay. We actually hit way higher than that. Our average is actually near triple that value. Is it? But that's what we enter in to start conversations.
And that's what you bench the investors, their expectations at?
Yes.
So you're over delivering and under promising.
Exactly that. Yeah. What I know is if that's not over 20%, I'm going to have a difficulty selling that. Yeah. Because internally I then have to sell that and bring that investor in. So that's our second metric. I'm not a massive fan on 20% on GDV, 25% on GDV because I just don't believe in it. Because we've done projects that are 12% on GDV, but a 80% IRR on cash. Why wouldn't you do that deal? Yeah. So that metric is important for debt.
Funny enough, so there's a lot of questions on why construction companies run on such a low margin. Yeah. It's because a lot of their costs are pass-through costs. They get paid before they pay the supply chain. Yeah. And obviously, as long as the contract is, and it's like, they call it a traditional contract, so if there is anything that new come up so they can recharge for it, or they're on any type of contract like that, they can operate on relatively low, what looks like low margins, is because they're not funding the development. Effectively, the client's funding the development. So it's cash positive. Yeah. So their actual return on equity, even though they've made a single-digit margin, their return on equity is triple-digit. Yeah. That's the key. That's the key thing there. It's when they enter into contracts that they take all the risk. Yeah. And it's way for thin margins. They inevitably at the best, because it's risky business.
Yeah, completely agree. And our last metric is, so we've got the net per annum into our business, the IRR, which enables us to sell it externally.
Yeah.
And then we've got the profit on GDV, which we only use as a metric to make sure that we're not going to run into a problem with debt and valuations.
Because I think, isn't it right that if you're going to get funding, they do look at the profit on GDV?
Yeah, believe it or not, I spoke to a lender the other day, and they look at down to 12% on GDV after finance costs.
After finance
costs. As a lend.
Yeah. When I know that a lot of them were looking at 16% of pre-finance costs.
Yeah, so our metrics are above 20% on GDV after finance costs. I don't get anyone in this world, and it kind of annoys me, that say pre-finance. Who, like, in their right mind, doesn't put finance into a development? Because no one doesn't have finance in the scheme, and if they buy it cash, they should be putting that metric in there to pay themselves a return on their money. So beyond me, but anyway, so that's after finance. And then our final metric is our stress test model, which is if the GDV goes down 10%, if the bill goes up 15% on top of our 8% contingency, which is 23% total, and if the scheme takes 50% longer than it was supposed to. If all of those things, three things happen and occur on the scheme, and the scheme still makes a profit, we will deliver it. Okay. So if those four metrics align,
that's quite robust. Yeah. Right. That is robust, and that there is, probably one of the fundamental reasons why you'll keep going through this market, and no doubt have every faith that you'll achieve your desired targets. And just before we finish, and there's been great value for the audience listening to this, for experienced developers looking, people wanting to get into investment development, what would be just a final, if it was an inexperienced person watching this at the moment, what would be just the number one, and I know there's so many things they got to do, but what would be the very first thing, if you were starting again, no experience, what should they do if they wanted to get into development?
Yeah, I personally would get yourself into a position where you could offer up free time to help people in other businesses. And I would go and work in a HMO business that's growing. I'd go and work in a development company that's growing. I'd go and do some work experience in a slightly bigger development company. I'd maybe go and work at, in a planning team, do a day with a planning consultant. I would model all of those businesses, look at your goals, at where you want to go, what you feel that you could enjoy the most and get the most satisfaction from, that could achieve your goals. I feel that we had one of our first employee, actually, wanted to get into property. He worked for us for 2 years on probably not great money for his capabilities, but by the time he left our business, he knew everything.
Great.
He knew everything. And
build that knowledge part with practical experience. Correct. Being immersed in the real world.
And all of that risk is on the business owner, but he's interpreted and learned all of the knowledge. Coincidentally, he was in a very fortunate position. He's actually become a passive investor in the business and gone and saved the world.
Great.
But he wanted to learn the ins and outs of it. And he only invests with us.
Makes him a much more confident investor as well.
Exactly.
Seeing the ebbs and flows and what to expect.
Precisely. But if he was at the start of his career and wanting to be that sponge, that would be definitely something that I'd recommend. It doesn't have to be 2 years worth of work. It could be, work experience or offering up time in replacement. There's a lot of jobs in our company that is just very admin heavy, and we all need, the only thing that we're mostly short of is time. So offering up that to basically learn off other people and their own risk appetite and how they've done it. And you don't have to do it yourself. You don't have to go, they've done it this way, so I'm going to do it this way. You could go, I'd rather have this model or that model.
You know what's going to happen now, don't you, Jack? You have messages now.
We have had work experience. People come work for us, and they get a lot of work done in that process.
Yeah, no doubt, and they get a lot of value too. So if any of you are lucky enough to get accepted, I'm sure it'll be of high value.
I think that's what I would do. And just, you can't. There's no end of free content and information on YouTube, books. I'm a massive learner of other people. So I joined boardroom groups and connected with other people doing other things, and that's how, essentially how we met.
Definitely, me too. 100%.
And I speed up my learning curve very quickly.
You got to be immersed in it.
By learning off others. So attend hit that hard, attend the events, meet people, ask them what they're doing, how they're doing it, how they've got there. That's going to be expedited information. It's going to be what they've learned over 10 years in a sentence, and then they might go for a coffee with you and tell you a bit more of the details. So just learn for the first, few months. I think that's essential. And then when you know what you want to do and you've got a business plan together and it fits in with your goals and it fits in with your capabilities and also what you can achieve, just get on and do it. Because I also see a lot of people out there that are, I want to go do this, or I want to go do that, but they're not putting it in. And it starts with, is the work ethic there, the execution? Like I definitely still work, heavy hours.
I know you do.
And I don't know if that's just naturally ingrained in me, but I think that has actually been essential to the growth of our businesses. Maybe not if we just did one and just ran one company, but
can't help yourself, can you?
Yeah, the hindsight's a wonderful thing. But it's funny, we were talking about sales, and we've actually considered bringing sales in-house. And I'm not allowed to set up more businesses. You can't stop yourself, can you? Because my view is, if someone can't do it as well as you, why would you bring them in and pay them a fee? It's difficult to...
I know, I feel where you're coming from for that. I really do.
Yeah. Well, we'll pay an estate agent 180k this year.
Yeah, well, like I mentioned, with recruitment, we've spent over 100,000 this year in recruitment. It's hard getting talent, and they command good money to allocate a job. But obviously, we're not on the sales market. But if we was traditional house builder, we would be working with
we could have one person sell all of those 75 units on 50 grand a year and commission and save 100 grand and have more control, and that person would probably be better than what chancellors are knocking out at 21 grand a year plus commission. Fact.
No, it makes sense. I mean, Jack, we could talk for hours and hours and hours, and I'll always get good golden nuggets for you, and I know the audience will as well. But for those that are listening, just Google Jack Jiggins and you'll find loads of content on him. He gives it all away for free, pretty much. But do reach out to him. Jack, if anyone wants to get in touch with you, how do they do it?
So Facebook, LinkedIn, Instagram, Jack Jiggins. It's a fairly unique surname.